If you're tired of taking bad trades, getting stopped out, and feeling like the market is against you, this is for you. The difference between losing traders and the pros is basically a systematic approach. In this video, I'm going to give you an A+ rating checklist, the exact blueprint I use to filter out weak setups and take only the highest probability trades. This checklist has changed my trading. Now it's your turn. So let's get into it. First up, we have liquidity sweeps and fair value gap alignment. So this is what separates smart traders from the crowd. We want to see a sharp liquidity grab where price pushes through the stop levels. For example, here we have stops here. So price pushed through stop levels, and this is followed by a clean reaction to the upside. So why is this? Because this confirms that the institutions are stepping in and we're not just guessing. If the reaction is precise, that's a major green flag, and in this case the reaction is very, very precise. So as you can see, market instantly came down, instantly went back up with strong momentum. This is telling us that market wants to at least hit this higher liquidity up here. So after our liquidity sweep and fair value gap alignment, we want to see some strong momentum, no choppy movement. So strong, smooth price action is key. We don't want to see weak, choppy moves. If price is grinding sideways like this, then that's a huge red flag, and that's definitely not going to be an A+ trade. We want to see explosive reactions to key highs or key lows. For example, like I mentioned before, the momentum candles. We want this to hit this lower high, this lower high, this lower high. So if price hesitates, that will not make an A+ setup, and we will not be taking that trade. Checking off step 2 and step 1, we're going to be looking for clear targets. So these are like equal highs, equal lows, trendline liquidity, intermediate term lows, intermediate term highs, and data highs or data lows. So every trade needs a target. The best setups are hunting liquidity. So we look for one of these 5 equal highs like I mentioned before. These are areas where market does want to move with extreme force. So it's basically, think about it like a magnet to the market. So we do have some trendline liquidity here where market wants to take out, I believe. So you see how market tapped up once, up twice, didn't tap here, however tapped here, tapped here. So this is strong trendline liquidity. There's a bunch of stops here. So when market runs through this, we should see a big move up, solidifying our trade. And not only that, we do have some lower highs here, which are strong points of reversals or strong points of continuations. So we're going to see how the trade plays out in a bit. Now let's move on to our fourth rule, singular clear fair value gaps. So not all fair value gaps are created equal. That's something that I have to make a point. If you're seeing multiple fair value gaps stacked up, that's basically like noise. We don't want to be seeing that. We don't want to be seeing multiple fair value gaps like this. We want to see one clear fair value gap like this. Just one obvious clear fair value gap. So we see in the 1 minute this fair value gap here and this fair value gap right here. Yes, it's small, but we don't want to be trading these double fair value gaps. We want to go into the higher time frame, for example, the 3 minute, to just create one big and obvious fair value gap. This is going to confirm to us that market definitely wants to at least hit this intermediate high. After we've identified our obvious fair value gap, we want to move to step 5 and make sure that we're in a discount zone, because think about it. We want to be longing at the lows and shorting at the highs. In this example, we're looking for a long. So we want to make sure that we are in a position where longs are worth to take. So we want to be using our Fibonacci. After using our Fibonacci, we want to mark from the top to the bottom, the highs to the lows. And everything under the 50% is a good longing zone. Everything on top of this 50% is a good shorting zone. So that's just something maybe you haven't heard of, or are just confused, and I just made it simple for you. So now you can start using it in your own trading. So that's basically step 5. So now we're going to be entering this trade, and we would enter off the close right here, put stop loss below the inverse fair value gap. And when it comes to our stop losses, we want to wait for a full close below. So if market comes all the way down here but doesn't close and then reverses back up, we're still in the trade. However, we don't have a hard stop, so in order for us to get out of the market, we want to be waiting for a strong close. So once the market closes below this inverse fair value gap, that's when we get out of the market. We want to be looking for our take profits and our break even. So in this scenario, our break even is the internal high closest to our entry point. So once we have that marked, we want to be looking for take profits. So I'm going to be taking a profit up here, and we want to be taking a first TP right here at this internal high. So let's see how this trade plays out. Okay, so we move stop to break even at this point because we hit our internal high. Okay, at this point we take out 50% and we would just hold the trade. If this trade goes all the way to the top, okay, we win, good, whatever. But at this point, we want to be making sure that we're still break even. So if market does reverse, we just take profits and win on the day. No matter how big or small the profits are, a win's a win. So let's see what happens. And looks like we're going to get stopped break even. Okay, so this is a really good trade. If you want to have access to my free checklist, all you have to do is click on my link in the bio and join my free Discord. I actually go live every single day for free, and I would hope to see you there. Thank you for watching.